Welcome back to another roundtable. My name is Adam. I have Rizmin.
Hello.
And Victor.
Hi, everyone.
And we have Craigie here, left by your son.
Yeah.
Yeah, okay. So today we're going to talk about the optimal order of investment. So a lot of times on this channel, we're always talking about stocks, how to invest and get returns and everything. But if you just think about it, investing in stocks is actually quite far down the list when it comes to investing. There's actually other things that you need to do before you get there. And there's an optimal order of investing. And we're going to discuss the steps that you should take. When you have a bunch of money, what do you do with it? And you go through these steps before you actually get to stocks. So the MAS has actually released an infographic, which is pretty comprehensive. But I think there are certain things missing as well. So we're going to go through what we think you should have when it comes to how you invest your money, right, in the order. All right, so what's the first step?
I think the first step is really the emergency funds.
Okay.
I think this is really, very, very important because we have to all agree that anything can happen.
Yeah.
Right. So you may lose your job, or there's economic crisis and you get a pay cut or something like that. Right. So your emergency fund, right, helps you to tide through all these what I call black swan. Right.
Okay.
You unforeseen circumstances.
And the black swan could be a personal black swan, right?
Yes, correct.
Something happens to you.
Yes, correct. Yeah, so there's a general rule is about 3 to 6 months of your monthly expenses, right? So there's a rule that, if you are single, it's 3 months. Okay, if you are married, right, so that will be 6 months, right? So, but I think everyone should work towards 6 months, right? Because in the event where you lost your job or you lose your job, right, you at least have 6 months to tide through
get back
the
on your
tough time
feet
to
and
get back
everything.
to the job markets and all this, right?
Everyone's circumstances are different for sure, right? So this is just a general guideline, 3 months, 6 months. I've known people who keep 12 months.
Yeah, okay.
Yeah.
Right? They know that they don't have people to fall back, if something happened to them or their family members, right? So, but if you have someone to fall back, let's say, your family happens to be very rich.
You have a sponsor.
Then of course, of course you can keep your emergency fund, shorter.
Okay.
Yeah, but as a rule of thumb, 3 months is the minimum.
So that's depends on whether you have dependent or no dependent. Okay.
Yes.
So there's also a general rule that if you have additional dependent, right, you just add an additional 1 month. Or if not, you still maintain the 6 months, but your percentage of the fund you increase by 10% or 20%.
Yeah.
Right. So it really depends on the number of dependents you have. Right. So when you have all these emergency funds, so what do? Do you put them sitting in your bank account saving with low interest rate? Right. So what usually I do is, right, I will take my emergency fund and I put into the Singapore Saving Bonds, the SSB, right? Okay. Because it's a liquid asset that you can take out within 1 month. Okay, so let's say if for me, right, I got 6 months, right, but I don't put 6 months, I put 5 months because SSB require 1 month to take out the funds.
The maximum, right?
Yeah. So I will put 5 months first, then I leave 1 month just in case anything happens. I still can use that 1 month, right? And after that, while waiting for SSB to take out, so that's what I did, right? And now the SSB interest rate you can see is like the latest one is about 3.32%.
Yeah.
Right. I think that's a good interest, for you to sit down there and
optimize your interest, right?
Yeah.
So this is based on your monthly expenses. So you multiply that. Okay. So that's a bare minimum that you should follow.
All right. So that's step 1. Basically, you must have a pool of money, cash flow, just in case anything happens before you actually get to investing.
Yes.
What is the second step?
I think the second step is to really pay off all those what you call your debt, your high interest debt, right? Because you do not want to compound the debt, right?
And it can go really high.
Yes.
I received the email from my credit card companies. They say the interest rate has gone up to, I think, from 24, used to be 24, now it's at 28%.
Wow. I mean, I have no idea. I pay off every month.
No, it's just part of their policy. I mean, I don't take on any credit card debts.
I know.
But it's gone up because of the higher interest rate environment.
Correct. I think if you are someone who's struggling with credit card debt, right, I mean, you should look out for helps and see whether you can reduce the debt, because the interest you pay is really crazy. I mean, I think they charge about 1% to
2% a month or something.
Which is that's about 20% a year. That's crazy. If you let that compound, you're making
someone is making off Warren Buffett returns off of you. That's what they say.
So I've known people who really balloon the credit card debt, and they still spend on their lifestyles and all this. Then they just pay the bare minimum every single month.
There's no way to get out of that.
Don't do that, because if you do that, right, you'll keep rolling it forward. Right?
This is the part that we want to add on the MAS guideline, because after the emergency fund they go straight to insurance, but some people are stuck with debt. But you have to clear it off first. Otherwise, your investing will not be able to compound as much as what you are paying with your interest.
Yeah.
So it really doesn't make sense.
And this is for high interest debt because just to make sure there's a distinction, because a lot of people have home loans and all this different. Low interest debt is fine.
Yeah. So
but this is
so I can share a bit of story. Not only like your credit card debt, let's say you use your university study loan and all this, you also should pay it off because the interest also quite high for that, right? So I think now the study loan interest is about 4%, right? And they allow you to drag all the way to 10 years. But actually study loan can be paid out very, very fast, right? What's the point of continue paying on the interest and all this? So my wife used to pay the bare minimum for her study loan moving forward. So what I help her is that once I built her emergency fund, right, I told her to pay down her study loan immediately. So every month her salary come, right, she will just keep paying down the study loan. So within less than a year, she already settled the whole study loan already, and then she start to build assess funds for like your CPF, your investing, your insurance and all this.
Okay. If your study loans is interest free, then
it's different thing.
Some people are able to get interest free.
But this is specifically like basically high interest debt.
Correct.
You need to pay that down instead of trying to beat that return, which is
correct,
there's a gamble and there's no way it's going to happen. So pay off your high interest debt because you don't want to keep digging the hole which you can't get out of.
Correct.
So that's step number 2. Step 3 is
protection.
Okay.
Right. So once you start to save up, all right, and of course you want to get some form of protection. Okay, because if you get yourself into serious trouble or you get hospitalized, right, you might wipe out your saving. That's what
your 3 to 6 months is not enough to cover everything, because if you get into like serious health issues, it can get really expensive.
So protection insurance is a basic thing, and we usually buy insurance for protection, and we hope we never use it. But it's I mean, I don't want to use it, right, personally for myself. But the bare minimum that you need to get for your insurance is, of course, the first thing is the hospitalization plan. Right. Personally, I mean, if you want to go some private hospital, that one is a must. Okay. But of course, public hospital, you still can go there, and then there are riders that you can come with it where you can actually pay minimum of, like, I think nowadays it's 5%. It used to be free, right? So nowadays you have to pay that co-payment minimum, right? So, and that's one criteria that you need to have. And the other one is, of course, the death insurance, they call it, right? Some people call it life insurance. So in the event, let's say, if you have dependents and anything happens to you, right, there's a payout. Right, and then that will helps to help either your loved one or your family members, right, to go through that tough cycle. Right?
So for me, I have 2 kids. So I and my wife, we actually sat down and we purchased the death and total and permanent disability insurance, term insurance. Right, I do it for until my kids is 21 when they reach adulthood. Right. So in the event that anything happened to my wife or I, we got a lump sum, right, to help for the kids, education or support the daily living costs and all this, right?
So basically, at 21, just you're on your own.
Basically.
On your own. You got to tell them that, so so they get prepared for life as well. But it's so important because anything can happen. I think hospitalization is very, very important because I think we're going to end up in hospital sometimes. Things are going to happen and you get really, really expensive.
So, and also, I think if you have a house, your mortgage and all this, right? For HDB, they do have the insurance to cover your mortgage loan. But I think for private, there's different, right? I think you shared just now.
There's I mean, you can get mortgage insurance for your mortgage. So basically, if someone passes away, your mortgage is taken care of, right? But I realized that you don't actually need to get mortgage insurance because if you get mortgage insurance, as you pay off your mortgage, the payout actually goes lower, but you're still paying the same amount of premium. It doesn't make sense. So it's better to just get life insurance. Basically, the same thing happens if you die, you get the same payout, no matter what, and then you use that to pay off the mortgage.
So as the mortgage. Mortgage
correct.
Insurance,
it kind of protects you. You just plan everything out to what payout you need if something happens to you. Protect yourself, your house, your dependents, and stuff like that. So that's step number 3. You need protection. Number 4, which is not in the MAS infographic, which I think is important, is to actually put it in CPF. Actually,
the low-hanging fruits.
Low-hanging fruit. And the reason for that, I think, is because, for me anyway, is because number 1 is a fixed income. I remember reading some thread on forums as well. It's like someone's talking about, hey, why do I should I put it in the CPF or stuff like that when I can just put it somewhere else and earn a higher return? And another commenter was saying, hey, look, you don't have to always think of your investments in terms of absolute return, because you got to think about how you want to diversify and protect yourself as well. And CPF is one of that if you like putting money in CPF. And of course there's tax benefits as well
if you do the top ups.
So I think that to me is the next step before you actually put in stocks. It's actually up to the individual here. I do it myself. Do you guys do it?
I think the CPF is like a place to keep you grounded, right? Because a lot of times when I talk to younger generations or what, right, they want to get higher returns. They don't want to put the money into the CPF. But if you were to think about it, right, the more you're greedy for higher returns, right, you're rushing for the returns, right, instead of looking at the downside, right, you keep looking at the upside, right, then I can tell you the chances of you making mistake is very, very high. Right. So you should always have your base covered first, right? So if you just treat the CPF like fixed income, like you put out there, you know that you sure get your 4%, right? And you cover your base first, right? Anything excess you can go out and do your best to do your investing, but you know that there's something behind, right, that is protecting you, right? So instead of you always everything go into the like high returns and all this.
So I like CPF because I remember at one point I was kind of like not so pro CPF, and I realized my taxes were very high.
We all been through that.
I was like, hey, I made a lot of money, and then it's like, hey, why is my tax so high? And then I realized if I just, instead of paying the IRS, I pay my CPF.
Which
it's
goes
the same
back to
thing,
you.
you know. But the money belongs to me. And my tax
it's
goes
a
out.
very good scheme. I think it kind of like kill one stone with kill two birds. It kind of like allows you to save, at the same time it allows you to invest into fixed income. Right. Through that minimum return of 2.5% for your ordinary account, and of course 4 or up to 5% on your special account and MA 4%.
So I think there's also a lot of people debating whether you should max out your FRS and all this. I mean, it really depends, right? I think if your income is very high, right, then you should use it as a tax benefits to reduce, right? You don't max out so fast. Right? You use it to reduce your tax every single year. Before, if you max out very fast, then you got no avenue to max.
I mean, it's 8,000 a year. That's what you can do. But
correct.
Just the maximum. But I like that. Some people may disagree, but I think it's basically a tool that you can use.
It's just another perception.
It's just another tool, and I would use it myself. So that's step number 4, and which is available to all Singaporeans and PRs, which is I think something that not everyone in the world has access to. We have that. And what's the next one?
I think this stock investing.
Now we get to stock.
So that is always the last actually. After you have to do all this, finish the front order, and that's what exactly. I didn't been through that. Because I was like, when I was young, nobody told me that, so I direct go to the stock.
Correct.
I go the opposite way.
And some people nowadays, they go direct to crypto.
It's different. So like when I help my wife, I know that I make the mistake, right? So when I took care of my wife finances, right, I do the order exactly like this. Right. So because at the end of the day, I hope she can retire well with money, right? So that's why
you don't want to work forever. Is that what you're saying?
I want to work forever. Correct.
And of course, the question is how much percentage of your income you set aside for the investment. Right? I think based on MN's guideline, I think they suggest to invest at least 10% of your income for retirement and other financial goals. Right, but for someone who is starting out, like if you are fresh grad and then you just got another job
and you got no dependent,
staying with your parents.
I think because your expenses has been quite kept at low when you were a student, and it's a lot easier for you to don't spend too much. So try to save and allocate as much percentage as possible, right? So like I used to save 60-70% of my income, right, and then that allocated for investment. Now, if you ask me, can I do that?
No, I can't. It's so hard now.
Because I have dependents, I have a family. There's a lot of expenses coming.
It's a good thing because it's not only that, because you can save more, but you do it earlier as well.
And then you build up.
But I think a lot of people don't get the concept, right? When you're young, you got no dependent. That's the best time to save. Right?
Yes.
And what I notice is it's quite 50-50 now. Some people do that and some people don't do that.
I think there's a balance. I mean, there are things in your 20s that you want to do and spend on because you'll never be 20 again, for example. But you still is an opportunity to save a lot. How much did you save? I remember you were like 80,
I was very high.
80% or something.
80%, very high.
He has a friend that I remember was 90%.
90%. That was like, I don't think, I can't do that.
Because my friend literally don't take bus. He cycled to work every day.
So they save a lot.
So if your income is low and you save a lot, right, you can build up a sum of money at your early stage, right? Then you will become easy, moving forward, right? It's less stress. Because once you start to have spouse and kids and all this, that's where your expenses will go up.
And you want to enjoy life a little bit.
Yes,
You want to go to
correct.
nice restaurants,
Correct.
go on a holiday.
Yeah.
You don't want to like live
Correct.
life like,
Yeah.
always saving money.
Yeah.
What's the point of that as well?
Correct.
You know?
I mean, because
So you do have
that's
to
why
spend.
I always say is you take your early years to save.
Yep.
The later part of the year you have to spend your money. No point bringing it into the grave, right?
Yeah, okay.
But
So, go ahead.
some other spouses actually help you to save more money.
Okay.
So they actually give you more money.
Okay, that's good as well. So but back to stocks. I think, again, when it comes to stocks, it's not just one size fits all as well. Again, it depends on your financial goals, your risk profile.
Yeah.
And that will kind of decide what kind of stocks that you invest in.
Yeah.
So the stocks have so
I
many
mean, there's a lot of
different
strategy out there. You have to really find ones that really suits your character, right?
Yeah.
So I mean, when you starting out as a new or amateur stock investor, right? Definitely you'll make mistake. We have to leave it, right?
Yeah.
So if you want to be safe and slowly build up your knowledge, right? Start with small sum of money. Start with a easy strategy that you understand to execute first.
Yeah.
Build your confidence, right? And build your wealth from there first until you feel that, okay, I really understand how the stock market really works. Then maybe you can, and I know the investing style that I'm using works for me.
Yep.
You can slowly branch out to maybe growth and all this. Because if you direct go to growth stocks, it tends to be volatile, but you must able to ride through the volatility.
And if you're new, you don't know how you're going to react when you hit volatility.
If
Some
you
people are
haven't
different,
trained your emotion, right, to like, let's say the stock dropped 50% and you really panic, right?
What are you going to do?
Then growth stock is really not for you because growth stocks can really fluctuate up and down very fast, right?
All right. So again, it takes time and again experience to kind of like figure out that strategy for yourself. It's different for everyone. Even though like the three of us, we are in the office. I know you guys 15 or more than 15 years. I don't know.
Yeah.
And we interact so much, but the way we invest is
different.
It's a little bit different as well.
Yes,
It's a little bit different. Even though we kind of subscribe to the same philosophy and stuff like that, it's still a little bit different. So you will find your own style and what you like.
The style should suit your emotion.
And your how much you want to put the effort and time into it as well. All right, so these are the 5 steps that we have when it comes to the optimal order of investing. This is what we think works best. I think, again, you have to fit it to your situation. I think in general this works. So again, to recap, number 1, you're going to build your emergency funds. Number 2, pay off high interest debt. Number 3, insurance protection. Number 4, CPF, and number 5, then you get into stocks. And then beyond that, there's other things already. Some people may go into other things. I have no idea. All right. So I hope that was really useful for you. Is there anything else you want to share, guys?
No.
That's good. All right. So my name is Adam. That's Rusmin and Victor. Thank you so much for joining us. Any questions about this, put them in the comment section. If you like this roundtable, hit the like button. And of course, subscribe to our channel. Many more roundtables coming up. And we'll see you again.